In today's video, I want to talk about using the long call calendar spread on Robinhood using Robinhood's option strategy builder. So basically the new way to set up long call calendar spreads, a lot easier, a lot quicker as well. So let's go ahead and let's take a look at how to do this. So the first thing that we're going to want to do here, and let me actually first start by saying the long call calendar spread is a neutral strategy. So this means you're going to make money when the stock trades sideways, when it doesn't move a whole lot up, a whole lot down, just kind of moves sideways. And so the first thing you want to do here then is find a stock that you're neutral on and that you don't expect to move much in price up until the expiration date that we're going to choose here in a little bit. So let's say I'm neutral on American Airlines. And again, this is just an example. This is just the ticker symbol I'm going to use here for today just to show you guys how this works. Again, this is just an example, so don't copy this exact same trade. But let's just pretend that I'm neutral on American Airlines over the next, let's just say, day from now till tomorrow. I don't think it's going to move much from where it's currently at, and I want to implement a long call calendar spread on it. Let's take a look at how we would set this up. So the first thing I'm going to do is I'm going to go into the options here for American Airlines. And what you want to do here is you want to go to the top left here. There should be a button that says Builder on it. Now again, not everyone has access to this yet, but you should be having, you should have access to it pretty soon. But if you do see this, you would want to come here, click on this button that says Builder. This will take us over to Robinhood's option strategy builder. Now, the first thing you want to do here, just double check, make sure that the correct stock is showing up here, that you didn't accidentally go into the wrong stock or that somehow the wrong stock got populated here, so that you're not using the strategy on the wrong stock. So as you can see, right, we have American Airlines selected. That's what we would expect. So now we want to go ahead and we want to find the strategy that we're interested in. Again, today we're focusing on the long call calendar spread. So you can scroll down here and find it, or we can just click on here to filter for all the neutral strategies available right now, because again, this is a neutral strategy and we should see it here. So under calendar spreads, we should see long call calendar spread. And as you see, this is a neutral strategy. So again, this makes it a lot easier. Now you don't have to remember the names of all these strategies or if they're bullish, bearish, neutral. You can just come in here and find the one you want. So let's go ahead now and let's go ahead and click on long call calendar spread. So again, just very quickly double check to make sure you pick the correct strategy. You don't want to be entering a completely different strategy by accident. Now, the first thing I recommend doing here is right next to this name, you should see this button with a question mark. I recommend coming here and reading more about, how the strategy works. It goes more in depth than what I'm going to go into here, right? So the basics, calculations, monitoring the trade. There's a lot more information here. I recommend reading through this before you place your first trade, just to learn more about the long call calendar spread. But anyways, let's go back here. So the first thing we want to do here is choose proper expiration dates. Now for the long call calendar spread, this strategy involves two separate expiration dates. And you can see that on the top right here. You have two different options here for expiration dates. So basically what's going to happen is we're going to sell a call, and that's going to have the closest expiration date. Then we're also going to buy a call that's going to have the further out expiration date. So that's how this is going to work. So you do need to have two different expiration dates. The closer expiration date is the expiration date of the call you're selling. Further out expiration is the expiration of the call that you're buying. And I'm just going to go ahead and leave it as is. So the call I'm selling will expire tomorrow, and then the call that I'm buying will expire a week from tomorrow. And again, what I really like about this is that it tells you how many days are left until that expiration. So 1 day until February 3rd, 8 days until February 10th. Now, that being said, let's actually talk about the long call calendar spread and how it works, how you make money. So ultimately with the call calendar spread, what we want to do is we want to determine what price we believe the stock will be at on the closer expiration date, or on the first expiration date. So the expiration date of the call that we're selling. We want to determine what price we believe the stock will be at on that day. And this is going to be the strike price then that we choose for the call that we're going to sell and the call that we're going to buy. And by the way, right, the price that you come up with that you determine, that's the price it'll be at on expiration, that price should be relatively close to the current share price, since again, we should be neutral on the stock. We shouldn't, again, the belief here is that you don't think the stock is going to move much in price. So whatever price you come up with should be pretty close to what the current share price is. So let's just pretend, again, for this example here, that I believe that on the first expiration, which is tomorrow, let's say I believe American Airlines for tomorrow will be at $17 a share. So again, current share price is $17.05. Let's pretend tomorrow I think it's going to be at 17. So again, I don't think it's going to move a whole lot. So then again, what I want to do is I want to find the strike with the $17 strike. So, or whatever the closest strike price to that is. So if I come up with $17, I'm looking for a strike of 17 or the closest strike to that. And there is a $17 strike. So this is the one I'm going to end up choosing. Now notice here, there isn't a place to select calls or puts, because since we selected long call calendar spread, this is using only calls. So Robinhood already automatically selects calls here for you behind the scenes. Secondly, notice that there's only an option to choose one contract here, even though I mentioned we're selling a call and we're also buying a call. Why is that? Because again, they're both going to have the same strike. So when you select one of these, it's basically, again, automatically choosing that for the call you're selling, as well as choosing that for the call that you're buying. You can actually see that up here, short/long. So short is the call we're selling, long is the call we're buying. So basically, they're both going to have the same strike. So I'm going to go ahead and click on this one right here. So as you can see, Robinhood recognizes this as a long call calendar spread, and it automatically fills out all of this for us. So we're selling a call at the $17 strike with this first expiration, so February 3rd. Then we're also buying a call, same strike, $17, but the expiration is this further out expiration, so February 10th. You should be entering this for a debit. That's also going to be the most you can lose, and then you can kind of see how it's going to look like down here. Now remember, before you actually enter this trade, very important to look at what your profit losses will be depending on the date, the share price, implied volatility, all of those things. So I highly recommend you first head on over to OptionStrat to visually take a look at your trade. So I'll put a link to OptionStrat in the description below. But let's take a look at how we can look at this here. So let's go to build and let's just go under basic to long call here. And once we head on over to long call, let's search the stock that we're looking at. So American Airlines, AAL is the ticker symbol. And so again, what are we doing? We're selling a call, and then we're buying a call with further out expiration. They both have the same strike. So again, I said, firstly, you want to determine what price you believe the stock will be at on the closer expiration date. And we want to sell a call at that strike. And then the strike for the call that we're buying should be the same. So I said, okay, let's pretend I believe that on February 3rd, which is tomorrow, American Airlines will be at $17 a share. So we would want to go ahead and sell the call at the $17 strike. So let's do that here. So here is the call we're selling at the $17 strike, expiring February 3rd. Now again, we also want to buy a call with a further out expiration, but the same strike. So I'm going to go ahead and buy a call now. And I'm going to change the expiration date of this one. We chose February 10th for this. It should have a further out expiration. But again, it should have the same strike as the call we're selling. So it should look something like this. OptionStrat recognizes this as a long call calendar spread. So again, you're entering this for a debit for this example, about $21. That's the most you can lose, whatever you paid. We have our max profit here. According to OptionStrat, if you have the premium version, chance of profit, 60%. And then we have our break even. So at expiration, we want American Airlines to be between these two prices for us to make money. Now, what you really want to happen though at expiration is you want the share price of American Airlines to be at the strike of the options that you entered. So again, the strike is 17. So at expiration, we'd want American Airlines to have a share price of $17. if we actually take a look here, that's where we would make our max profit of $16 or so. So as you can see, at $17, that's where we want it to be tomorrow when the market closes. That's where we're going to make our max profit here. Now, the other thing I want to mention here is that we always need to take a look at what happens with changes in implied volatility. So let's actually take a look at that here. So here IV is 44%, but take a look at what happens if IV drops, and then take a look at what happens if IV goes up. So you definitely want IV to go up on this one. But again, you should always check it and make sure you're aware that changes in implied volatility will affect the trade. Finally, guys, one last thing I want to mention here. So when expiration date comes tomorrow, keep in mind that's the expiration date of the call that we sold. The call that you bought still has another week until it expires in this example. So generally, the majority of people, what they're going to do tomorrow, they're going to close out of their entire position. They'll close the call they sold, they'll close the call they bought, and hopefully you're in here and you make some profit. Now, you also do have the option of just closing the call you sold, and if all of a sudden you're bullish on American Airlines, you could leave the call you bought, and if American Airlines goes up in share price, you can make some more money. I think that's less common, and ultimately it's up to you, but keep in mind, you do have some options at expiration. So anyways, if you have any questions, feel free to leave them in the comments section below. Let me know what you guys think, and I'll see you guys next time.